Well, hello guys, and glad to have you on board again today. This one is definitely going to be an absolute cornerstone for your progress into trading. You probably might want to look at this one multiple times if necessary, because there's going to be plenty of information to process. And let me be clear, today there's going to be a huge and long introduction because of many warnings before going any way further. This is, like I said, a keystone into your strategy progress. That's the reason why I put the stamp color as being both yellow and orange, because this is not a pattern that you consider as a step function, okay? It's probably going to be more of an incremental function, pretty much like what you've experienced when you were learning the third range boundary. You first need to get familiar with the pattern, process it into replays and stuff like that before trading it into real market territory. Going real slow with it, the tiniest possible leverage at first, and then slowly but steadily increasing. So all of those things you've done in the past to get to learn the third range boundary, and remember it took somehow something like 3 to 6 months approximately to get through this before you get to a fully exposure trade on the third range boundary. It is going to be exactly the same context in what we're going to be teaching you today. Okay, so this is not something you just think, okay, I get it, I go fully exposed to this. It's definitely not the case, and it takes a freaking long period of time. More than that, as you get to progress through this, you will get to some more experienced stuff, which means there is going to be emergence of more personal psychological biases. They're the ones we've talked about previously, and actually these are still the same. There are still two biases in human trading, the impatience biases and the fear of uncertainty, but they will just roll back into a different perspective. So that's the reason why I'm going to introduce a second psychological management video later on into this trend series to talk about what problems you might experience as you get to trade trends. Okay? So we're not going to go deep into this and save it for a specific purpose video later on into this TL series. But really keystone today, okay? Because it isn't just going to be as simple as it sounds, because it requires a management and knowledge, a perfect knowledge and mastering of everything we've seen previously, okay? So if you're trying to play today's patterns without fully mastering everything we've seen previously, and it's going to take the third range boundary knowledge, it's going to take all of the trends knowledge. Basically, everything we've seen previously was just a path to lead you to what we're talking about today. And it requires to be fully mastered. So that is why I'm getting a little bit talky today about this thing, but I really want to be real clear about that. If you try making today's things without knowing previously and without fully mastering the previous stuff, you're going to take a higher level of risk taking, okay, but without compensating the risks. This is where this can go real problematic. You should always consider that taking more risks can only be done if it's risks managed by something you understand. Okay, I'm not talking about understanding the market. I'm talking about understanding the risk management procedures. So, real quick warning in here, but I wanted to make it real straight. Okay, I don't want to go dramatic. It's not that complicated. You can definitely make it, but just make sure you do it well. If you do it fast, if you try to run faster, it's necessarily not going to work, or it's going to be heavily much more dangerous than you might think it is. Okay, so despite that, let's go for the bright side of it. When you get to master this pattern, you'll fully get profitable. There's not even a chance that you cannot make money into trading if you fully master this, because this is definitely, among the entire progress into your strategy, the one that is definitely going to lift you up to making money durably and safely into markets, because you're going to profit from trends. And when I say profit, I say really profit, because this is really a big multiplier of your trend gains without never taking too much risks, because we're going to use something in here. That's the basic psychology of this pattern. We're going to use trend as a reference for us to safeguard as our increasing risk taking. Just like we stated, trends use 3 time frames reference, and we're going to go down to the riskier part of it, which means so far we've seen how to assess the underlying structures of trends, the pullbacks and stuff like that, but we always stood to 2 time frames. So today we jump into the 3 time frame stuff, which means we're going to use the breakout as our reference, but we're going to trade 2 time frames below, which means we're freakingly aggressive, going 2 times shorter time frames. And in that perspective, that means real aggressiveness, okay? But we're going to compensate that risk taking by the fact that we need to have a breakout. So that's the reason why you must be fully confident that a breakout is occurring if you want to apply this pattern. That means you need to fully master the trend behaviors, its multiple changing structures, the wave 1 extended, the wave 5, all of those things should really be handled. You should have traded multiple trends by now if you want to go down this road. All right, enough talky introduction. Let's get to our PowerPoint support, and then I'll probably take 10 minutes or something to get into real market example, showing you, of course, I'm still going to use the S&P 500. So we have the same reference of what we've saw previously for the breakout and accumulation trade, because I want you guys to see how these magnificent trends like there was in the S&P 500 over the latest years was absolutely crucial and very rewarding if you navigated them well. Okay, so let's jump into this. All right, let me just grab it on my end. Okay, so first things first, like I said, you need to understand the fucking thing about trends, because if you use those patterns elsewhere, it's definitely going to be a hell of a risk taking. So you need the breakout and therefore the trend. And remember that the trend is approximately 20% of global market behaviors, because most of the time we're locked into ranges, and trends are just the things that push us away from point A area to go to point B area. Okay, and in that perspective, the trend, the really vertical way in which one of the counterparts has totally disappeared, generally occurs less than 20%. Okay, so make sure you don't use the pattern too often, otherwise that means you're probably taking a little bit too risky trades and you're going aside from the rules. Okay, so really make sure that this goes right after the breakout. And the breakout must be validated. This is one of the things, once again, must not be subjective right now. You should know what a validation of a breakout is. Just as a quick reminder, the breakout validation is reporting the trend channel's amplitude to the upside on a 1-to-1 ratio. Okay, just not going down this road. You should know everything about that and do it clearly well, of course. So what we're going to use, like we said, if you use it elsewhere, it simply doesn't work. It's really freakingly efficient in terms of profit multiplier. I'll explain later on about this one. Okay, you're going to have to scroll to lower time frames to use it, down to a 2 time frames lower scale. Okay, and they require you to be absolutely able to perfectly place the third range boundary. If you do not, there's going to be a hell of a problem, but normally I consider that up, but at that point, you should be doing this naturally without even further questions. Okay, that's pretty much all about it. Let's get into the pattern. Okay, so we're going to use what we call a reference time frame in here, which is going to be the trending time frame. So your breakout should occur on this reference time frame. Okay, so if you're breaking into weekly, in here we're going to say we're breaking into the daily charts. Okay, remember what a breakout is: breaking on top of the resistant context, breaking multiple trend lines, breaking the trend channel as well. So breaking multiple clusters, breaking cycles. When you see this, you should say, okay, there's definitely probability for a trend trade to occur. Where is my validation level? Okay, we've reached out to this level, go on. That's the starting point in which you can start looking for these patterns we're going to talk about today. So when you have all of these pre-requirements checked, you'll get to look on the lower time frames. What did you say? 2 time frames lower? So daily H4 shouldn't be H1? Yes, it's going to be H1 that we trade on, but as you need to look at the H4 as well, I think looking at the H4 context is great. What's that going to require is that you're going to have to manage 2 time frames at once. You're going to look at the market in the H4 reference time frame, 1 time frame below our daily reference, okay? But remember that on an H4 time frame, you see both the trend channel, which is the H1 context. So you're going to trade the third range boundary patterns, but you're going to trade them on the trend channel, which means you need to be able to fully place and visualize the third range boundary, how they behave and stuff like that, okay? And you're going to have to manage 2 time frames at once, read both the context and the trend channel to fully master this pattern, okay? The rule I'm going to introduce in here is that if the pattern triggers on the H4 context, okay, so we're going to trade the H1 patterns, though with the trend channel. When the pattern triggers on the context, you stop trading the H1 timeframe processes and you take the profits on the target area for the H4 trade. Of course, all of this might sound a little bit shady for you right now, but you'll see with the example, it's really, really way easier for you. Okay, so this is what the pattern looks like. Okay, made it real simple for you to understand. So the process is real simple. What you're going to do is, of course, market is breaking at that point, is reaching out at least the validation of the breakout, okay? then the market will somehow retrace on 2 time frames lower. So remember that you will break your trend channel, which will reverse, and you will get a third range boundary on the trend channel, on the H1 trend channel though, okay? You should see a validation of it. What a validation of the third range boundary is, reaching out the trend channel. Oh, but I don't see the trend channel on my local time frame because this is the trend channel already. So at that point, either you scroll down to the H1 time frame to make sure it validated, or you just assess that as long as you see a price reaction, you very likely have reached out the trend channel. Okay, what matters is that you should see the third range boundary early reaction. Sometimes it will build a triangle like that, sometimes it will make a lower low point. All of those things, we don't care. What matters for us is that we have a third range boundary plotted on the charts, clearly visible. And in that perspective, what we'll do is that we'll wait for the fourth range boundary to plot itself, and we're going to put an order, market order, into the third range boundary level. So you're going to use a stop trigger type of order, which means this is an order that would trigger as the market goes on. So you will buy the market as it rises. You stop order this thing, okay? You put a stop bullish entry order out there with a stop loss down the previous low point. Either this one if this is a triangle, or of course you can put it into this one if you want a safer placement, okay? So that's how the pattern goes. Then the pattern should absolutely reach out to the 1-to-1 ratio to consider being validated. Okay, so once again, that requires you to fully be able to place the 1-to-1 ratio. Okay, and as this is in here, so you will take all the range reference, double it to the upside, not using the lower shadow candles, okay, only the closes. You take the lowest close into this trend channel, double it down to the upside, out of the third range boundary breakout level, and you'll get the 1-to-1 ratio. Prices should get there, and generally they will do it absolutely precisely. Okay. The pattern has a variant, otherwise it would be too easy, okay? Sometimes the third range boundary would just be called squeezed, which means there is so much bullish momentum for following from the breakout that we don't nearly even trade third range boundary. We just don't want to wait, and in that perspective, we'll get squeezing third range boundary levels. And in that perspective, there's always a pullback there. Literally always. It's literally magical. When you'll see that pattern, it occurs so often, and it's goddamn precise. So you really need to learn this one. Okay, so like I said, sometimes the third range boundary level will be totally fucked up, which means we get in here, we reverse the trend channel, so the trend channel goes bearish, and where we should meet the trend channel, instead of building the third range boundary, we fuck it all up. Okay, but we need to reach out the 1-to-1 ratio. So in here, there's a little tricky area, which means sometimes you'll see an early price reaction within the trend channel, okay, and then the market breaks it up. Sometimes it just goes as a straight line. So when it is a straight line and you're not even going to be able to highlight the third range boundary level, then you simply take the assessment of you need to reach out at least 1-to-1 ratio over the trend channels being met. And if you do that, in order to figure out the level in which you should trade, take 50% of it. Remember that normally the breakout level should be in the middle as we're doubling 1-to-1 ratios. So take 50% on the closes. Remember that you don't give a shit about the lower shadows. So take the lowest close, take the highest close, and put the market order in the 50%. It's not going to be a market order in here, it's going to be a limit trade. Because in here, you're buying the market as it goes towards you. This one is a stop order trigger, this one is a limit order trigger. Okay, so you put it either at the third range boundary you've seen, or if you can't figure out where the third range boundary is, 50% over the lowest to highest candle close. Okay, the stop loss is set out of the previous low points, of course. That's pretty much all about it. But this pattern, of course, validates when it retraces back to the 1-to-1 ratio it traded previously. Normally, the market will always extend over these levels, but you at least make sure it reaches out this level. So this is all about it, okay? The entry is either you break or you pull back on a broken, squeezed third range boundary. The stop loss must be set below the previous low point with a maximum risk taking of 2%. Never go anywhere beyond that. We're already taking quite some risks, and you'll see that even a 2% risk taking in this pattern will bring up some significant levels of gains. The thing is that in here, if you get too greedy, you're going to take higher risk taking without nearly being able to figure them out. And at some point, don't forget that we don't know anything about the market. We just put it into little boxes and chaos is still there. So if chaos somehow emerges and and you just took a 10% risk on a trend follow trades, you're going to lose 10% capital. So don't be dumb, okay? We're just trying to make money, not out of a single trade, but out of hundreds of trades. We're just trying to be profitable as we trade. The more we trade, the more money we make. So make sure you sustain your profitability by not putting all of your money into single trades, okay? So that's how it goes. Validation is at the breakout ratio 1-to-1. If you don't know, look at the TL number 12. That explains that pretty much in details. The confirmation doesn't exist, and it is a crucial point for this pattern. If you put the fucking stop losses at break even, this is not going to work. This pattern simply does not work if you put the stop at break even. So don't be dumb, and we're going to talk about that a lot when it comes to the psychological management of these patterns. If you put the stop loss at break even, you'll destroy the entire risk reward ratio. So don't do it. I'll teach you some ways to overcome the psychological pressures of willing to do it. Your brain is definitely going to tell you, man, put the stop at break even, put it, so I'm going to be safe. Just don't do it, okay? Just don't. There will be a point in which you'll be able to put it at break even, and I'll let you know later on, okay? So the target in here, and it's absolutely crucial, keep the fucking trade as long as possible without putting it at break even too soon, okay? It's really crucial to get a maximized risk reward ratio. If you do all of this, okay, don't put the stop at break even, fully manage the risk with a maximum 2%. But of course, before reaching 2%, like we stated, it's not a step sequence. It's really like you're going to go slowly but steadily, starting at lower expositions, below 0.5% capital, and you'll slowly increase. And the better the confidence you have in the breakout, the higher the level of risk-taking you will go down to without ever bringing up to 2%, okay? Overcoming 2%. But there are plenty of shaded gray area in between. If you have very limited confidence into your breakout structure, then you're definitely not going to risk 2%, okay? If you're not yet experienced with the pattern or the stuff like that, definitely don't go 2%. Always up for the lowest risk possibilities, okay? And go easy, go slow on this one. Practice a fucking lot before exposing yourself down to the maximum level. All right, that's pretty much all about it. Let's jump into a real market territory, real chart. Like we said, we're going to use the S&P 500 as a reference out there because that's the one we've talked about for all the previous patterns and the breakouts and the accumulation. So we're going to stick with the same market. So you will have the broader picture of it when we terminate this series of video. And we're definitely not yet done because there's plenty of stuff we're going to talk about. Okay, let's go into a technical chart. All right, so first of all, on the left chart is what you should care about. Figuring out that you have a mature range, it's absolutely necessary. Okay, of course, in here, the range, the range was extended in the past. Okay, you have a market top that is in here you don't see. Okay, so mature range, this is our fourth range boundary. This is our accumulation trade. Okay, we've seen all of this previously in the previous TLs. This is where the breakout occurs. This is where we break through the resistance context, the trend channel, we break cycles, we break trend lines. Jesus fuck, this is where we really go trend. Okay, so at that point, this is where it starts. But do you start applying the pattern right now? Fuck no. If you apply the pattern in here, I'll kill you. That's not how it works, okay? The pattern starts when you reach out the 1-to-1 ratio. So this is the validation of the breakout. So this is the 1-to-1 ratio over the trend channel's last low point. So your 1-to-1 ratio is somewhere in here. Okay, this is your breakout level. This is your lowest candle close. So risk-reward ratio of validation is there. So as you reach out to this point, you'll be okay. In that perspective, in here, I somehow doubt the fact that we had some breakout in here as well. Okay, so in that perspective, you would have been validated in here. Okay, no big deal. Okay, let's considering out that way. Both cases, it works just fine. So this is the moment we start applying the pattern. Definitely not before. If you try applying this pattern on a breakout that is not yet validated, you seriously destroy your risk-reward ratio. So be patient. Once again, everything works out if you put the patterns at play following their guidelines, their context, and their rules. In here, the context to apply this pattern is a validated breakout, not the breakout itself, a validated one. Doesn't have to go right up to confirmation, okay? Just validation is enough. All right, let's jump into a lower time frame charts though. So this is the area in which we start doing it. Okay, so of course we were weekly on the previous time frame. I just scroll down to one lower time frames in our multi-layered stuff. So daily, Okay, and I'll get to play the pattern with the 2 time frames. I'll of course get to have a look at the context, make sure it doesn't trigger the pattern, because if it does, I will stop using the H1 time frame as a reference, and I'll just play with the trend channel as long as it is. So first things first, like we stated, we wait for the trend channels to be broken. You can either put a goddamn alert, like you put an alert on Pro Alert telling you when does the trend channel reverse. When do we have a bearish trend channel? And you'll get an alert. When the alert triggers, you know that a third range boundary is going to come. Either it's going to be validated, which is the case in here, or it's going to be squeezed, like this one. But what you look for is just a trend channel's reverse. As long as it reverts, you know the pattern is going to show up. Either this one or this one. It's going to be either validated or squeezed. Okay? So in here, we see that the pattern validates. We made a fourth range boundary. I'll teach you how to buy the goddamn trade in here, but that's a topic for more experienced traders. This is definitely a much more aggressive trade for orange level, okay? So not for now. But what you're going to do still is the same. You're going to put a stop trigger order at the level of your third range boundary. Remember, you take your highest candle close, okay? So you go in here. This is where you put your limit, your stop order. You get in here. As the market breaks the level, make sure that you already plotted your validation level to be alerted, and you put your stop loss down to the lowest candle close. Okay? That's what it is. 1-to-1 ratio is met. Great, your pattern is validated. Don't put the fucking stop at break even. Or if you absolutely want to secure your gains to have a better mindset, what you can do out there is to pay for the stop loss. What that is basically when you reach out validation, when you start using those patterns, you are granted to use this intermediate risk management, which is going to be much, much better for your psychological management. So use it if you have problems handling your psychology out there. Okay, so remember that what you must never do is to put it at break even, because if you do this, just like we have in here, pull back, you're out, end of story. Okay, which is totally stupid. So rather than that, if you feel a lot of pressure, you're not yet familiar with the pattern, not confident enough, or you have some doubts with the breakout structure, then in that perspective, you take 50% profit in here, and that is going to pay for your stop loss. But you live it out there. If you want to know why, that's real simple. The trend is there to save your ass. Normally, a trending market doesn't break supports, but it can pull back to some supports, which is exactly what happens in here. We pull back to test the support, but we're definitely not going to break it. That's the reason why your stop loss must be set under the support levels, not on them. Okay? So this is what it goes. You really want to do this. Let your stop losses below the low point. Don't put it on a break even. And if you have a lot of problem managing your psychology, just pay for your stop losses by taking a 50% profit on the validation target. Okay? Then you let yourself ride that shit as long as possible until you get another trend channels reverse. During the trends, like we said, you're generally going to have an average 2 patterns to trigger. Okay, which means some trends trigger just once, some trends will trigger up to 3, but rarely more than that. So if you reach out 3 patterns being triggered into your system, stop using the pattern. You know that the next time it's very likely going to be the full hour, it's going to be the higher time frames reference that's going to trigger. Okay, so we go on. Trend channel is broken. Fairly nice. Okay, we'll let the second range boundary show up. It's really deep retracement. That's fine. Okay, we go there. Third range boundary should be there. We see the market works a little bit, and bam, we break it. So where is your 1-to-1 ratio? Right there. A little bit higher, sorry. Okay, so here is your third range boundary level. Here is the lowest candle close. So here is your 1-to-1 ratio. We made it right here, not there. So here's where you validate the pattern. Here you can, at that moment precisely and not there, put the limit order on the market, and you're going to buy your third range boundary pullback. Okay, you buy right in here, and you would see that in this context you even have support from the trend channel, which is definitely great. Into this pattern you definitely want to take the maximum risk taking. Okay, of course, if you're experienced enough, if you get to learn the pattern, don't go 2%. But you go in here, that's real fine, okay? There's no signal for this pattern. This pattern is real simple. You really pay for a level and let it ride. As we risk manage our probabilities of being proven wrong by the fact that we should be in a breakout, and normally prices should keep rising up whether you like them or not. So there is no signal to trigger this pattern. There is just a technical structure, okay? So this is how it goes. In here, as you took a second trade into this point, you are going to be able to put this one at break even, not before. Okay? So at the moment you put a next trade, remember what we said previously, this is when you can put the previous one at break even. That's really important step, because if you forget about it, then you will have eventually up to 2% risk taking on this stop loss. If you leave it out there, you're going to do the same thing in here with a stop loss in here with an additional 2% risk taking. And now what happens if for some reason something totally fucks up your trend, chaos or any other external catalyst and stuff like that, and prices do bam, you just lost 4% capital, which is absolutely stupid and absolutely not possible. So in that perspective, you will always expose your capital up to 2% and never exceed that, which means if you reinvest 2% capital and risk into those trend follow structures, you need to delete the risk on this one. Okay? So like we said, if you want to get the maximum gains, you need to let these trades open as long as possible. So you just cannot close this trade. That would be stupid, right? So you leave it open, but you put it at break even. That's the only risk management viable solution. And you keep it riding. That's the second pattern in a row. So remember that there is at best just one left, and it's not even guaranteed. Okay, but you start being cautious with the next pattern. Goes on. Okay, still making fairly high points, very great. Bam, reversing the trend channel, great. We go back there, we meet the trend channel, we don't even work prices. That's one of those cases in which we go real straight line, but you note this level. Do we reach out the 1-to-1 ratio? This is the lowest candle close. Oh man, no, we do not reach out the target, and we don't even get closer to it. So you certainly don't put a limit order in here, okay? Remember that you put the limit order when you get to the target, okay? So in here, you don't buy. And bam, the market fucks you up. So should ring a bell. The pattern doesn't match. The pattern isn't met. It's imperfect and gets broken. We getting to break support should start ringing some bells. Anyway, you've had 2 trades ongoing, so you knew the third one was risky, and you didn't take it. But still, you retrace the context this time. So the rebounds is so quick that you actually don't even reverse the context. But I would say in here, whether you like it or not, there is a very likely probability for this pattern in here to be a 4-hour context one rather than the H1. Okay? So anyway, at that point in here, I would consider that the target, which is there. Okay? There is a third range boundary. It's just there is a question mark in here on whether you consider this one being an H1 time frame one on the trend channel or a 4-hour one that just didn't trigger because we've gone too fast retracing. But anyway, there is a third range boundary in here, and I hope you've seen that, okay? So the pattern triggers. So either you take this one as a third range boundary broken up. Do we meet the 1-to-1 ratio? Yes, we do, because this is where the lowest candle close is. So your target is in here, and it's met right here. So when you reach out the target, as you've squeezed the third range boundary in here, you have 2 choices. Either you consider that, okay, it's gone 2 times, now it's getting volatile. It's probably right now that the divergence shows up. And how do you feel it? You trace the trend line and you see the market is failing to meet the trend line, which means the pace is starting to slow down. That is a sign for divergence, okay? So either when the pattern triggers on the reference time frame, on the local time frame, which is our daily reference, okay? You start thinking that the market is slowing down. That's a clear evidence for you that the divergence is coming along the way. And that is one of the things we're going to use as a good starting point for us to assess the probability of the divergence trade to show up, which is one we're going to talk about on the more experienced stuff, okay? So in here, what I suggest is that in this specific case, it's still questionable whether or not we trigger the pattern on the 4-hour chart time frame, but I would considering very nice to profit take in here. Okay, so whether you do it or not is kind of not a big deal, but I would personally profit take in here and consider that the pattern might have triggered on the H4 time frame. Still, you can buy this one because in here the pattern just works out. You've squeezed the third range boundary. Oh, sorry, not there, but there. Okay, you reach the target, you can put a limit order on the market. But as you would have guessed, in this specific case scenario, if you bought this one, you're definitely not going to take a 2% risk. You know that something isn't playing perfect. So it's risky, but anyway, you could still take that trade with a low risk taking, And of course, like I said, I would totally suggest you profit taking the previous trades, which would have been a freakingly nice gain. Let's just give it a perspective, okay? So this is the price you would have got in, okay? The stop loss would have been approximately, Jesus, let's call it 80 points, 85 points or something like that, okay? You must put it below the lowest candle close, okay? Not necessarily below the lowest shadow, just below the lowest candle close. So in here will be 80 point stop loss, okay? Let's figure out how much money you would have made. For an 80 point stop loss, you would take 440 points gain. So in here, the risk-reward ratio is staggering, 5 times, okay? And like we said, imagine that if you took a maximum 2% risk taking, you will get a 10% capital return out this on just a single trade. Not even to mention that this one will add up on the gains, of course not a 5 times multiplier, and you still have the accumulation trade, the breakout trade, and you can see how really maximized a trend behavior profits could be. Because you add up on the trades, you have multiple boxes that pile up on top of each other without ever taking too much risks. Okay, that's really the key in here. The difference is that you always do this without ever taking more than 2% risk at a given time. So in the worst case scenario, if chaos just hits the corner for whatever reason, you cannot lose more than 2%, but you can make some shitty nice gains when the pattern just meets the target. Okay, so it's exactly how it goes. And in here, just to give you a perspective, that would have been a 270 points gain for an approximate, okay, that would have been a stop loss in here for the same thing. For an 80 point stop loss, you would have gained 270, okay, which is of course real great. It's far less than the previous one, but it's still a fairly nice level. It's more than 1-to-3 risk-reward ratio. So both of them combined, more than 1-to-5 and more than 1-to-3, as you can see, come up to the average I gave you previously, an average 1-to-4 per trade, which is staggering risk-reward ratio. And of course, we take some risk because we go 2 time frames below the reference breakout time frame, but of course, the breakout should compensate for this risk taking. Okay? So make sure you don't break the rules, because in here, for example, if you break the rule, this one is going to be a 2% loss. Totally going to be covered by the other guy's gains, but still, okay? That's really important for you to figure this one out. Remember that as you take another trade, always put the previous one at break even. You don't pile up the risk, okay? You reinvest the risk. And when you take the first trade in here, make sure that all your previous trades, like the accumulation trade and the breakout trades, are at break even. Of course, not the breakout trade, okay? The breakout trade never is put at break even. This one goes on, okay? All right, here we go. So at that pattern in here, if you ever take this one, you need to understand that at that point, the pattern of divergence shows up. I'll teach you how the divergence shows up, but if you ever took this trade, you're going to have to profit taken in here, okay? That's absolutely necessary. I hope you do understand why, okay? Because at that point, we're making high point. We still have a third range boundary, but if you trade this one as a breakout, you'll see that there is clearly a problem. The market isn't meeting the trend lines anymore. It's really going divergent. It's not about time to trade the breakout of this one. That would be the 4th one in a row. Like we stated, it never, or it's never going more than 3. I don't know any case in which it does. I mean, there might be some cases that do, but they're far less significant. So consider that if you've done it 3 times, just stop doing it. Stop it, okay? Then, of course, in here, as the divergence pattern shows up, I'll teach you how to trade it efficiently, but that's for more advanced stuff later on in the perspective, in the series. And of course, in here, the pullback triggers, okay? If you roll back to the weekly chart time frame, you see that we retrace down to the context, we'll reverse it, and stuff like that. Remember the things we've talked about previously? If you didn't even profit take your patterns already, which means for some reasons you've missed the divergent pattern, or some markets will not plot the divergence pattern, in that perspective, don't forget that if you reverse the context on the pullback, you need to take the profits on your trend follow trades on the third range boundary that follows. Okay, so if you forgot about locking your gains in here, you're definitely going to have to do it in here. As you can see, it would have been the exact same price, but there is a huge difference in between. The fact that if you take it in here, you're not exposed to these portions of prices. which means this is always a risk. The market is never safe. It's always chaotic. So the longer you stay without risk limiting, the higher the risk for you to be exposed to some external chaos. So it's far less risky to get the fuck out in here rather than in there, even though in terms of actual rewards, that would be the exact same thing. Okay? So always go for the safest option. Don't try to lock on your gains too soon, but in here would have been nice to do it. At least 50%. Okay, I hope you don't understand. You don't listen to this. It's no big deal. I hope it's not going to be... It's no death sentence, don't worry. It's just a practice. Okay. And don't forget that you can just take 50% on the profit in here if you really want to maximize the gains of your trend trades. Remember that the pullback is not the end of the trend. The pullback is just a pullback, and normally we go final excess. So as you get to really master these patterns, really later on, and as you really get experienced, I'll teach you that you can take just 50% profit taken in here and leave the rest to get to even further down the road patterns. But it really is riskier, okay? That's pretty much all about it. So I think that we do have more than enough stuff to reach out conclusion. Okay, so if you get my points, there are several rules that needs to be mastered in here. That's the reason why I made a quite long introduction out there. I'm going to go really quicker on the conclusion. So if you use these things without mastering either the one-to-one ratio, third range boundary placement, trend assessment, and organization, this is not going to work. Remember that if you go for a fifth wave extended, there is not going to be divergence, there's not going to be pullbacks and stuff like that. So fifth wave extended, you fucking profit take when the risk rises. Because if you do have trend follow trades, plus the divergence, plus the accumulation, whatever, you're going to have a freaking shit ton of leverage in the market. Don't be dumb enough to let it rise, to let it fall. Take the profit ASAP, specifically on the fifth wave extended. Okay? On the wave extended, like we said, you're probably going to miss the shot. It's absolutely not possible to trend follow H1 time frame. Wave 1 extended. Wave 3 extended is the one we just talked about. It's the easiest one to navigate. That's the perfect one because you have the accumulation trade and so on to already prepare you to maximize the gain. As the breakouts show up, go 2 time frames below and trade every fucking third range boundary breakout or squeezed patterns. That's exactly how this thing goes. When the pattern triggers are on time frame reference -1, okay, so on your context, you just stop applying the pattern and think about locking the gains. When you get to be familiar with the pattern, you will eventually just take 50% out there and spare the rest to try putting right up to the final excess. But we're going to have to manage it differently, which means we're going to have to trade the divergence to compensate for the risk. This is when we'll get to real arbitrage, and this is the thing we're going to talk about into the next level of difficulty. So it's already not that simple to get there. But if you really get there, if you master those patterns, if you truly understand how multiple structures of trends can orchestrate in a different order and stuff like that, if you know how to maximize risk-taking into the trending behavior step, if you know how to efficiently profit take when you reach out either the divergence detection or if you fail it, take it at the third range boundary of the pullback. If you do all of this well, and if you'll be able to fully expose yourself up to a maximum 2% risk taking into this trend follow stuff, and there are some other patterns I'll teach you later into the next video, but if you orchestrate all of this together, man, you're going to make some nice gains. And that is seriously overperforming the market's behaviors, but never taking too much risk. You don't go down the pyramid scheme of taking multiple positions, and if things do not go well, you lose a shit ton of money. You're never going to lose more than 2% in this perspective, but you can make serious shit ton of money. It's not going parabolically risk-taking, because remember that there's a time-limited offer. So it's really all about putting all the pieces together in a well-defined order. And the better you get at trading it, the better you'll be at taking profit from it. So it's really an incremental function. The more you practice, the more confident you'll get. The more confident you get, the more you will expose yourself up to this risk 2% limit, and the higher the rewards will be. And that's pretty much all about it. And then you'll stop looking at the market as, oh, how can I make money to this thing, but just applying goddamn rules. You'll stop looking at thinking about where does this market can go, where should I buy or sell, but just applying goddamn rules. You have a structure. And at that point, if you're there, you've made the hardest part of learning trading. So if you ever get down to this point, and like I said, looking at this specific video is something you probably will do multiple times. When you reach out this point in which you fully master these things, Jesus fuck, you've made the hardest part of it. And that's really, I think, quite rewarding for you at that point already, without even thinking about the fact that there are plenty of other stuff I've got to teach you later on. It's far more exposed later on, and you will even multiply it bigger than that, okay? So that being said, it takes some time to master. If you try to rush your thing in, it's not going to work. So I'm sorry about all of those warnings. It's just because I know how exciting this can be to make money into trading, but this is not a safe process if you try to rush it. That being said, I'll leave you guys with that. Being still quite positive, okay? It's just that I know how exciting this could be, and overexcitement is definitely not great. So try to be rational. It takes some time, but it's definitely worth it. That being said, see you guys into the next video.